see so many of you today. We're suffering here in Helena from the smoke of the wildfires that are drifting in from Canada. So I don't know what it's like in the rest of your worlds, but hopefully those fires will be out soon and we will not have a smoky summer season. We're really thrilled to have you all joining us today. We have a great turnout. I just have a couple of opening remarks and then I'll introduce Omar and turn it over to him and his team so they can walk us through the investment performance. But I want to share with you just a few MCF highlights today. This year, the Montana Community Foundation is celebrating 35 years, and we're so proud of that. We could not do it without all of you, without your partnerships, without your generosity. We're also really proud of the milestone that we have awarded across Montana now more than $100 million since our inception as an organization. And $100 million goes a really long way in Montana. And that's a big number here, and it matters. And it's because of the collective effort of all of us, including our friends at Cambridge, that's even possible. So thank you. We've been having some anniversary parties around the state, and we're going to continue having those over the course of the summer. So we'll have parties coming up in Missoula and Polson and Billings and Bozeman. And if you haven't seen the dates or you're interested in attending any of those, reach out to us. We'd love to make sure you have all the information in terms of dates and locations. A couple of hot off the press items that I want to share with you. First and foremost, some of you may have seen the news that we shared last calendar year that the investment committee had committed $1 million of our portfolio to invest in real estate in Montana. And our friends at Cambridge worked really hard to find investment opportunities. And they just shared with our investment committee today that all of those $1 million have now been deployed to support low to moderate income families and communities through Fannie Mae investments. And those investments are now providing housing resources, financial resources to 5 Montana counties. So thank you, Cambridge, for hearing us talk about the importance of Montana and finding that great investment opportunity for us. Also happy to report, hot off the news number, that we will be granting more than $900,000 in scholarships. In fact, our team is going all around the state, informing those students and celebrating those students at graduation events. In fact, it's almost $1 million this year, but it's a big deal for us because it wasn't long ago that we were actually awarding about $450,000 a year. So $1 million for Montana scholars matters a lot. Another big milestone that I want to share is, in fact, this afternoon, Governor Gianforte has told us that he will be signing the bill that the legislature passed to increase the amount of the charitable endowment tax credit and eliminating the sunset of that tax credit. So we'll be doing quite a bit of marketing and outreach about that tax credit, but the tax credit will go from $10,000 per taxpayer to $15,000 per taxpayer, or $30,000 for a married couple. So we're very excited about that. You probably saw our big news about our endowment payout, but again, another blockbuster year. We distributed more than $4.3 million across the state in March in our annual endowment payout process. So, we've had a lot of great things happening. One of the things that we have consistently said as an organization is how important endowed philanthropy is and how important a long-term investment time horizon for our endowment is. And we have been so fortunate to have great guidance and assistance from our outsourced Chief Investment Officer, Cambridge Associates, Omar Sanchez, and his team. And the markets have not been all upward trending in the last few months. We've had a little bit of volatility, but we still feel we're very well positioned to ride out that volatility. So with that, Omar, I'm going to turn it over to you, and thank you for being with us today.
Thank you, Mary. Delighted to be here as always. Great to see you all. Just want to be the first from our side to congratulate you on 35 years. That's an amazing milestone, $100 million. When we hear things like that, it really kind of makes it real and brings home how important the work that we do to partner with you so that you can, in this case, support Montanans. And so just congratulations. We're really happy to hear that. So I'm here with my team, Tim Shepard and Raul Najera Bajena, who is also here. We are live to you from Boston. Again, very delighted to be here. What we're trying to do here is obviously give you an update on the portfolio performance. We always try to make sure that we're framing it within the context of what's happening in markets, because that's obviously critically important context. So just to back up in terms of an agenda, what we'd like to do, only for, on the small possibility that there are a few that are perhaps less familiar with Cambridge, just 2 minutes on who we are as a firm and a team, just to be helpful from that perspective. Then we want to spend a few more minutes on the investment approach. And we always like to do that because I think it helps provide helpful context on how we think about managing the portfolio, how we've been managing the portfolio on your behalf, and how we continue to manage it, particularly through current market dynamics, which is likely quite relevant. And then, of course, we'll spend a lot of time on performance. We'll look at shorter term periods, longer term periods. We'll get more specific in terms of asset class performance. And we are delighted to answer any questions that you might have along the way. So if that works in terms of an approach, Raul, if I could ask you, thank you, Mary, if I could ask you to pull up page 3 in the Cambridge materials, and we'll start there. Thank you, Raul. So, we have a couple of, I think, important data points here. The key takeaways from our perspective is that we are truly a global firm with a global research platform, offices essentially in 7 different countries around the world. So we have boots on the ground, whose primary job is to really find the investment ideas out there and get our clients access to them. We've been working with institutional clients actually for 50 years. This is actually our 50-year anniversary. So we share that in common in terms of a milestone. And we've been working with clients on a discretionary basis, OCIO, for 20 years, just to give you a sense of how long we've been working from that perspective. Raul, if I could have you switch then to the team page. Thank you. So this is your outsourced team. I am, the chief investment officer for the team. I'm again joined by Tim, who's our head of portfolio strategy. In terms of takeaways here, the way that you can think about us as truly a dedicated team, your dedicated investment team for the Montana Community Foundation, leveraging that global research platform that I just referenced, specifically focused on, well over 100 investment manager research professionals whose only job is to scour the investment landscape, identify those best ideas, and then we get to choose from those best ideas and then work with our in-house operational infrastructure to actually implement those ideas on your behalf, manage them, and ultimately manage this portfolio for long-term growth, which is the ultimate objective here. So that is very brief, quick and dirty on the firm and the team. Again, what I'd like to do is now transition to Tim, who's going to talk about the investment approach, and then I'll come back on to spend some more time on performance.
Thank you, Omar. It's great to see all of you. Raul, if I could have you just pull up the, I think it's page 6, which is the Cambridge Associates investment philosophy. And while he's doing that, I'll say one thing. We've been around for 50 years. And, for those of you on the last donor webinar, you'll see that this is very similar to what we showed the last time. And that's because we don't change our stripes. We've got a very long-term time horizon, and we don't change, just on what's hot in the market or what the fad is. We really stick to our guns. So here we've got our investment philosophy. It's very important to how we manage investment portfolios, and we think of it as our guiding North Star, guiding everything that we do for our client portfolios. First, I've already said it, but it's incredibly important. We take a long-term view. We focus on long-term compounding and growth for our client portfolios. For the Montana portfolio, we don't think looking at the short-term timing markets is repeatable. In fact, we've got a page that shows how that can actually be to the detriment of investment portfolios, because it often means missing market rebounds and locking in losses if you do kind of wild swings, moving money in terms of risk management. So therefore, we really do prefer long-term investment partnerships. We invest with managers where we think skill can drive outperformance, again, outside of timing. And despite our long-term view, we are very risk aware. We don't just set the portfolio up and just let it go. We actually spend a ton of time looking at it regularly. Despite not making short-term decisions, we're constantly tracking the portfolio. We are your OCIO. We're always on. We're always thinking about the portfolio. We make sure we have the appropriate levels of risk and liquidity at all times, and we will make incremental changes as needed, depending on the risk and liquidity of the portfolio. For the Montana Foundation, we have built a customized portfolio. That's something that we do at Cambridge. We don't have some sort of cookie cutter, off the shelf product where you just go. That's not how we do it at all. We really like to get to know our clients extremely well and build a portfolio that's tailored to meet your needs. In this case, the portfolio does have a growth orientation, and that's, of course, so the portfolio can grow over time to do things like increasing purchasing power above inflation, so that the spending that does happen from the portfolio can be that much more impactful over time. In terms of management, we do emphasize active management, so investments that are making active decisions that might look a little bit different than benchmarks. However, we also, use passive strategies. We're more than happy to invest with passive managers. They do things like lower net of fees, increase liquidity, and give you kind of cheap liquid exposure. But going back to active management, we only invest in active managers where we have a high degree of confidence that they will actually add value above all fees. One thing that we do with active management is we do invest a big emphasis on private investments. And when I say private investments, you should think of things like private equity buyouts, venture capital, and things like that. And the reason is that we think at Cambridge, we have a real edge in the space. We think we are really good at it. And we've had a great success for our client portfolios, building successful private investment portfolios. And I'm happy to say we've had that success for the Montana portfolio. And we think of private investments as a real growth driver for the portfolio, given the ability for private investments to add significant value over public markets. But of course, we also invest in public markets as well. And speaking of private investments, if we jump ahead to the next page, we can take a look at some of the asset classes that we use to build the Montana portfolio. Here, I would call this, portfolio building blocks. You see kind of broad topics here: public equity, private investments, diversifying strategies, and then some example strategies. In blue, that's public equities. This is a significant portion of the foundation portfolio. As you can see, in terms of role, it's meant to be a growth driver. Within public equities, we do take a global kind of approach. So we want to maximize the opportunity set. So it's not just one particular geography or style. We do invest globally. So think US stocks, US companies, but as well as non-US companies in places like the United Kingdom, in Japan, but also emerging markets like India and places like that. Next are those private investments that I highlighted before. That's also a very key part of the portfolio and a growth driver. We have some example strategies here. Again, private equity and venture capital. Next, just going down the line, in purple, we have what we call diversifying strategies, which might not be obvious what that is, but this portion of the portfolio is meant to be a differentiated source of return and dampen equity risk. Some folks call this portion of the portfolio hedge funds, but it can be more than just hedge funds. Example strategies, think credit, arbitrage, but also some long-short strategies. And again, this is meant to provide a differentiated source of return and diversify, as the name says or implies. Lastly, are two parts of the portfolio that are meant to protect against inflationary environments. as well as deflation or economic shocks, recessions, and things like that. Inflationary, we use TIPS or Treasury inflation protected securities. These are bonds linked to inflation. And then within the deflation category, we have high investment grade fixed income, mainly Treasury bonds. And these are certainly more protective assets. They could be categorized as more defensive, and they're also important for spending. They're highly liquid and tend to be really important building blocks of the portfolio during periods of recession or shock in the equity markets. Jumping ahead to the next page, here's what we call the quilt chart. And to me, this is meant to show the importance of diversification. And again, you'll hear us say this a lot if you spend any time with us. We believe it's an important tool. Diversification helps meet investor goals, protect against risk. And in fact, it's actually a time-tested strategy. Unlike market timing, we think having a long-term diversified approach is the way to do it. So here, again, it's a quilt chart, a lot of information, but really what this is telling you is that each colored box represents a different asset class, and each column is a different year. And what you'll see is that the colors jump around a lot. There's no one asset class that's in the top category, meaning it helps to have lots of different exposures. So you'll see in 2022, the top performer is commodities. They performed really well in 2022. However, if you go back historically, they were the worst performer in 2020. They were the worst performer in 2014, the worst performer in 2015, and they've been a bottom performer in other years. Same thing with venture capital, top performer in 2020, top performer in 2021, but I think we all remember the dot-com crash. Venture capital is one of the worst performers. So again, the idea is so that we've got money invested in all these places that should allow us to have a smoother ride and benefit depending on what's working in the market. Really, to me, showing that diversification pays off and will help the Montana portfolio grow in a more steady fashion. Okay, I'll jump ahead to the final page before I do kick it back to Omar. Here, I did mention that our investment philosophy involves taking a long-term approach where we invest with an eye towards long-term performance, and we don't invest with a short-term kind of approach. And here's a simple illustration of why that can pay off. So the top chart includes historical performance of the S&P 500. That's the 500 largest companies that are publicly traded in the US. This goes back to 1980, so a long time period. And what this says is if you had invested in this index, you would have had an average annual return of 11.4%, which is a great return. However, if you were to time markets, and unfortunately, if you had done that and missed the 10 best days, so this is just the 10 best days over this 43-year time period, your return would be less. It'd be 11.1%. Jump ahead to missing the 20 best days. If you had just been out of the market for just those 20 days, you'd only have a return of 8%. If you had missed the 30 best days, so 1 month out of this 43-year time period, your return would only be 6.8%. And of course, no one really knows when these days are gonna happen. So our philosophy is to stay invested, take that high level of return and not miss the days, stay in the market and allow that compounding to work in our favor and work in the Montana Community Foundation's favor. I think, Omar, you were gonna make a comment on markets, so I'll kick it back to you.
Thank you, Tim. So yeah, maybe what we'll do then is, take a step back. I will provide a high-level overview of performance. I'll say a few words about what's been happening in the markets. There's never a dull moment for sure. And then we can provide some more specifics on that performance. So Raul, if I could have you then pivot back to page 1 in the materials, the portfolio highlights page. We'll start there. And I would note that all of this data is as of the end of the first quarter. I will provide you a real-time estimate of performance and the total portfolio's estimated value in a moment, just to give you more current information. But in any case, if you start in the upper left-hand portion of the page, you can see that total assets were just shy of $137 million at the end of the first quarter. Portfolio performance is in the upper right-hand portion of the page since inception, which is, call it 6+ years at this point, in terms of when we've been overseeing and managing the portfolio on a discretionary basis, and then 5 years, 3 years, and 1 year. A couple of observations that we'd make here is, first and foremost, it's nice to see over the intermediate and longer term periods, the portfolio has delivered positive returns, which is clearly what we are expecting to do. Particularly on the 3-year number, that number is actually higher and largely impacted by the strong performance of the portfolio and, of course, markets in 2020 and 2021. The 1-year number that you see is being impacted by the challenging performance, the sell-off primarily in equity markets, but also in bond markets in 2022. And so while we never like to see negative returns on the page, we understand that there is volatility and risk in markets, and not every year is going to be a blockbuster year, if you will. But what we were pleased to see, if there is a positive on that trailing 1-year performance number, is that relative to broader equities, the portfolio protected capital fairly well. It was down 5.7% over the period. Global equity markets were down 7.4% over the period. And against the policy benchmark, close to 200 basis points of positive value added. So the diversification that we have in the portfolio has been working. The active management that we have in the portfolio has been working. And we can see that similarly in terms of active management over those longer periods, adding positive value added across all of the periods that we're showing you here. The other thing that I would say in terms of the performance profile, or part of the performance profile that we're targeting here, is that ability to sort of bend, not break, if you will. We know that there are going to be periods in markets when markets are down, when there's a higher degree of volatility. The goal is to have a performance pattern that, doesn't gyrate wildly with what the market is doing, right? So that we can stay invested and ultimately really maintain that long-term view and benefit from the long-term upward trend in markets. Year to date, pleased to report we are in positive territory through the midpoint of May. In terms of an estimate here, the portfolio is tracking at 4.5% positive. And that would mean the estimated value of the portfolio is just over 137 million, 137.3 million to be a bit more precise. Positioning wise, we show that in the lower left-hand table on the page, positioning relative to our targets, which represent the strategic asset allocation that we have for the portfolio. What you can see is that there's not a high degree of variance over underweights relative to those targets. We're not really taking any sort of near-term view and positioning the portfolio from that perspective. We really are trying to be more neutral to this strategy. And we also see that when we think about the sort of estimated equity risk and volatility that, that we model for the portfolio. If we were to show you those numbers, you'd see that they're very close. And again, that is all about taking that long-term view, understanding the key to success is having an investment strategy and really sticking to it and having the ability to stick to it through whatever happens in the market. As we look forward, again, I'd be remiss if I didn't say a few words about what's been going on in the world. So I would say the following, as we look forward, we do expect markets to be a bit more choppy in the near term as the market discounts things like slowing economic growth and earnings momentum, tightening lending conditions. The market has been much more focused on that coming out of the failure of Silicon Valley Bank and several other banks starting in the beginning of March. But even prior to those events, if you had looked at things like loan demand, those were actually trending down and supply was trending down even in advance of that. And so we do think that lending conditions continue to tighten, which represents a headwind to growth. And then things like inflation, which have been coming down, but are still relatively high and certainly well higher than what the Fed is targeting from a monetary policy perspective. Speaking of which, we do believe that the Fed is more likely than not to pause on its rate hikes and not cut. Currently, the market expects that the Fed is likely to pivot later this year towards cutting interest rates. For now, we're taking the Fed at its word, and we're taking the Fed at its word because inflation still does remain relatively elevated, and the economy, notwithstanding the fact that it is slowing, remains relatively resilient and has demonstrated an ability to weather pretty significant interest rate hikes over the last 12 to 18 months, to say the least, close to 500 basis points. The only thing we believe that would sort of knock the Fed off that path and likely pivot to interest rate cuts is some sort of growth shock to the system, right? And that, I think, when we say that, where we would probably go next is obviously talk about what's going on right now in Congress with the debt ceiling, right? And we know that there is a date approaching. It's apparently June 1st or near that date when the government is not going to be able to fulfill its obligations unless the ceiling is raised. When you look at futures markets, when you look at markets that price in the probability of an agreement not happening and then the government defaulting, it is still low, but it is not non-trivial. And so the market is, we think, appropriately discounting that there is that risk there. Our baseline hope and ideally expectation is that ultimately an agreement is reached. We know that hope is not a strategy. And so from that perspective, it's important to remember that this portfolio is built to weather volatility and handle it. We have a high degree of liquidity that can support both spending and rebalancing if markets do get more choppy. And in terms of positioning, the range of outcomes is so wide that positioning for one scenario or another, we think, is just not prudent risk management because those potential outcomes are so wide and there's many different paths this could take. We'll continue to monitor, as everyone is, the situation to try to understand if we're getting closer, ideally, to some sort of agreement. But if not, we know that this portfolio is built to handle it until ultimately an agreement is reached, whether it's in advance of the X date or after it. And we have the ability to take that long-term view, and that's what we're going to do. And as we always do as well, we'll keep Mary and the committee informed, if anything, about our view changes and if that has any impact on how we're thinking about managing the portfolio. But that is not the case today in terms of where we stand. So with that as some highlights, I'm going to then pass it back to Tim to go a little deeper on performance. And then again, happy to answer any questions.
Great. Thank you, Omar and Raul. If I could have you pull up page 13 in our presentation. Thank you. So here we have a good amount of information on performance. I'll orient you to the top of the page. As Omar already mentioned, the portfolio is valued at $137 million at the end of March, so that through the first quarter of 2023, to the at the top chart, to the left-hand side, that's when we started working with the portfolio. We took over management right in the midpoint in 2016. And from that time period, it's a time period a little over 6.5 years, 6 years and 8 months, if you want to be precise. The portfolio has achieved some really nice growth. So we said earlier, around a 7% return since inception. But what does that mean in dollars? In dollars, that means a $73 million in growth, starting at $64 million and getting to where we are today at $137 million. So more than doubling, which is really great. We love to see these milestones. It's one of the reasons we like to work with clients over the long term, because we get to, experience and help out reaching these milestones. The two components of that $73 million in growth, one, it's investment performance. We're happy to say that the investment results have been very solid over this almost 7-year period. But there have also been inflows into the portfolio. When there are, inflows into the portfolio, that allows more compounding to happen. And the beauty of compounding is when you have more dollars at a higher interest rate of return, gets bigger and bigger. And it's a sort of beautiful virtuous cycle. So that is definitely what's been happening in the portfolio. Return wise, at the bottom of the page, we've got performance for the foundation versus its policy benchmark over a number of different annual time periods. And what you'll see is, there's some ups, there's some downs. The gray is the policy benchmark, the blue is the foundation portfolio. Happy to report that the majority of those are up. You've got a lot of really great years in the foundation portfolio, and it's actually one of the reasons we do take that long-term approach, is so you can benefit from those big years up. You have 2019 up double digits, 2020 up double digits, 2021 up double digits. Unfortunately, we had a pullback in markets in 2022, but because we stuck to our long-term strategy, we benefited from those up months. And despite the pullback last year, the portfolio is still up around 7%. Portfolio was down about 13% in 2022, so not immune to the risk, but there was some nice protection in the portfolio. The policy benchmark was down almost 16%. You had global stocks down around 18%. You had parts of the market like the NASDAQ, or the tech-oriented part of the market, down over 30%. So again, some nice protection, not totally immune, but down a lot less than markets. Fast forward to where we are this year, not completely recovered, but the portfolio is up 5% for 2023. So we have seen some rebound. In fact, if you actually go back to the end of the third quarter last year, that's around when the markets bottomed. Markets are actually up almost 20% from that time period again. So it's why we like to stay invested, focus on the long term, is because you actually get to participate in that rebound, and the portfolio is doing that again, up around 5% for 2023. Still early days, and there's still certainly risks to the outlook that Omar just mentioned, but we're happy to see some of that rebound, and we're happy to report that the portfolio is up around 7% since inception, and also adding some nice value versus the benchmark. If you had just invested in the benchmark, you would have had less growth, and it's been about 1% of value being added. So I'm going to stop there, and I think that's more or less all we plan to cover for prepared remarks, but would love to open it to questions from everyone who's joining us.
Thanks, Omar and Tim. Does anyone have questions? Teal, do we see anything in the chat? No? Does anyone have any questions you'd like to ask Cambridge or myself? While you're unmuting, if you do, I would like to recognize Sheila Rice has joined us. She's on our call today, and she's actually the chair of our investment committee. So Sheila, thanks for your commitment and serving as our chair. Questions? Anyone? Okay, if somebody has one, you can just interrupt me. I'm going to kind of drag out the conclusion here in case you do, but I'd like to, I'm sure I'm not going to be the first person to say this, but I would like to also congratulate Cambridge on 50 years. That's pretty amazing. We're really honored to be one of your clients and one of your partners in this process. You have been a tremendous partner to us, and we're grateful for your involvement and your wisdom and your guidance. So thank you very much for that. John Greenbrier has a question. What percentage? Oh, I just lost it. Teal, can you read it?
I can read it.
Oh, can you see it? Okay, go ahead.
I can see it, Mary. What
you.
percent of the portfolio is in commercial retail real estate? The answer is that directly there would be de minimis, if not any. You might see, typically where you might see that would be in the private investment portfolio, but we generally don't do real estate in the private investment portfolio, because if you look at the returns long term, they just don't meet the hurdle that we're trying to achieve for that part of the portfolio. Where you might find some exposure would be within the diversifying strategies allocation, but there, what you're more likely than not to see is managers trading on really compelling opportunities in terms of how that real estate is actually trading, meaning they're likely looking at things that could potentially be distressed or significantly discounted. That's likely where that would be played. But again, in terms of direct commercial retail real estate exposure, call it de minimis, and that's also the case for REITs. Is the growth purely from investment returns earlier, or are the gifts and contributions included in the return? So yes, it's both. We have, it was called 70 million in growth, give or take. About 40 million of that has been performance. About 30 million has been the inflows, which is fantastic. And obviously you all and Mary have been instrumental in bringing that capital to the portfolio. And as Tim mentioned, the ability to add capital when the portfolio is growing only has a much more positive impact on the long-term growth trajectory of the portfolio. So that ability to do that has been very beneficial to the portfolio's growth over the last 6, close to 7 years.
I have to chuckle, Omar, because when you and Tim use the word inflow, you think of that, that's obviously an investment word. And this is very similar to Casey and I having to understand each other's language. Those of you who don't know, Casey is our Vice President of Finance and Administration, and she speaks auditor and accounting. And so that means sometimes I have to think about the words she's using and realize that I don't necessarily use the same terms she does. So inflows means contributions, correct?
It does, Mary, and sorry, I know we sometimes
No, that's okay.
Yeah, the language is a little bit different, but yes, conceptually speaking, yes, that's exactly right. Contributions, and then those contributions come into the portfolio and we put them to work, essentially. And obviously the more money you can put to work on a positive returning portfolio is only going to increase that growth rate over time. So it's a very positive, both from a kind of a mission alignment and the ability to impact Montanans, and then also from an investment perspective. So it's a real kind of win-win when you're able to do that.
Thank you.
Yeah. I see a question about the top company or fund in the portfolio. I'm not going to be able to give you the top company. What I can tell you, looking across the managers that we have in the portfolio, the largest position that we have, and I'm just looking at the actual lineup of managers and their exposures. On the equity side, it is a U.S. equity oriented manager. It's about 6% of the portfolio, 6% of the portfolio, about $8.4 million. They are investing across the cap spectrum. They are likely to have within that portfolio some of the larger companies that you might imagine that are part of the S&P 500. So it would be a combination of some of those larger tech companies, plus some of the the Walmarts of the world and that kind of thing. The other large position that we have in the portfolio is just treasuries. That's about 10% of the portfolio, and those are just passively managed long-term treasuries. I don't know if that's helpful for that context. When was the last time the investment policy was changed or amended by Montana? That would have been last year, Mary, if I recall. And then I think it became effective earlier this year. I think the only major change that I think is perhaps most noteworthy is sort of maintaining the overall risk profile of the portfolio, but shifting the mix within the equity bucket more towards private investments to drive higher return. Still, the biggest allocation in the portfolio continues to be the public equities, but the mix over time will emphasize more in private investments, which we think and the committee agreed will allow the portfolio to grow that much more over the long term.
I would just add to that, Omar, just as a matter of our due diligence, the policy is reviewed annually by the investment committee. And so we take a very active approach in making sure that we all understand what the policy says, what we're trying to do, and make any necessary changes. We frankly don't change the policy very often. It's pretty steady practice for us. So great question.
Yeah.
Anyone else? John says.
Yeah, cash and treasuries is at 12.3%. Has that changed recently in this market, or is this the standard? The target asset allocation between treasuries and cash is 13%. So we're running relatively close to that. That has remained relatively consistent really from day one. if there's a positive benefit to what rates have done over the last 12 to 18 months, is that the forward-looking returns for these bonds are significantly more compelling than they were at the beginning of 2022. And, you know, philosophically speaking, we have a pretty strong view that it does not pay to try to forecast the direction of interest rates or make a call on duration. You know, these investments are meant to provide ballast to the portfolio and to provide liquidity in stressed environments. So they play a pretty important strategic role. And, you know, we've taken the view that that is really, you know, what needs to be the case. And so, you know, you should really expect that we would more likely than not be expressing any tactical view within that part of the portfolio, because of the strategic role that it plays and because of the importance that it is as a source of liquidity for the portfolio.
Thanks, Omar. Okay, I'm going to check the chat again. Any other questions? Well, with that, I hope that you all have gained more information about our investment portfolio and what we're aiming to do with that. And I hope you've also gained even greater confidence in our organization. Frankly, Cambridge brings a lot of credibility and stability, and we're very grateful for your partnership and your presentations today. So thank you, Omar and Tim and team. And with that, some of us are going to hit the road and head up to Glasgow for the LCF convening, but I hope the rest of you have an amazing rest of your week. So thank you very much for joining us. Take care.
Thank you. Take care,
Bye.
everyone.
Thank you, everyone.
Bye-bye.
Thank you.
Bye-bye.